Good morning and welcome to the Killik podcast for Friday the 23rd of January. This week's been a fascinating week for markets, especially yesterday with the QE announcement from the ECB. They managed to surprise the market on the positive side with a €60 billion programme until September 2016 or until inflation starts to react positively. This amounts to 18 months in its first iteration of 60 billion, so that's 1.1 trillion, which brings the balance sheet of the ECB back up to 2012 levels. It's also way above the expectation that we had going into the start of the week. So that's a sort of essentially also effectively open-ended until we start to see inflation start to pick up. They've also shared some of the liability for this programme. So there's a 20% shared liability, which the market wanted. They were worried about the German element in the ECB Governing Council stipulating that all responsibility would continue to lie at the national level rather than sharing that responsibility. So the objective of the announcement was to weaken the euro, and that certainly took place. So we saw a 2% drop in the euro against the dollar. And markets reacted very favourably to that. So here we can see since November that the DAX, key constituent of the European markets, has been on a strong run, offset somewhat for UK investors by a weaker euro, but here you can see the inverse correlation between that weaker euro and the overall European market. So weaker euro is very positive for European equities. It eases the financial conditions, which is what we talked about last week in the podcast. The other effect of QE is essentially to lower bond yields, and here we think the impact of the QE is going to be more limited. This is the European sovereign debt bond yields going back to 2012 when Draghi made his famous whatever it takes speech. So a lot of the work in reducing those yields where they were artificially high at that point because we were worrying about sovereign default and very liquid has now sort of been done. And so we think there'll be a limited impact of the QE announcement there. The overall effect of QE in Europe is creating a little bit of scepticism amongst the market. Part of that scepticism comes from the fact that Europe is now debasing their currency at the same time as Japan are being very active in expanding their monetary base and lowering the yen, and China are now starting to do a similar sort of thing. So the relative effectiveness of a weaker euro, if other exporting nations around the world are doing it at the same time, is diminished. You've also got in Europe lower levels of consumer indebtedness. So the impact of those lower yields in stimulating consumer expenditure is more limited, and there's bigger impact on their savings because they're not earning on their savings. So it's less of an injection into the real economy. And also with bonds yielding around 0.4 now on the sovereign side for some of the higher quality sovereigns, but the alternative, if national banks sell them back to the ECB, is a negative rate on cash with the ECB. We wonder where the stimulus to get them to participate in the programs will be, whether there's enough demand for the QE. On the upside, though, it's definitely good for global liquidity conditions. So that's positive for all risk assets, not just European equities, but all global assets. And we saw a good response in global markets yesterday, not just European equities. We do feel that this continues to take the downside away from equities and will continue to bolster the potential for a good earnings surprise in European equities going into this year. So we do see upside in European markets. The final sort of effect of QE that we're going to talk about here is that it will strengthen the US dollar. So this is US dollar this week. We talked about this a lot, but we think it's a very important part of markets at the moment. So early in the week, we had the Bank of England minutes where there were two constituents of the Bank of England committee that were looking to raise rates. They've now come back from that, and it's sort of 9-0 in favour of keeping rates on hold in the UK because of that inflation number that we saw earlier a couple of weeks ago. And then after the ECB announcement, we saw a further spike in the dollar index. So So this strong dollar is causing some complacency amongst the market about when the US is going to raise their rates. So here we've got a chart that shows when the market is expecting rates to go up. So you're expecting a gradual increase from where we are now through 2015-16 up to a point where we're around 2% in 2017. The Federal Reserve are ahead of the market, so they're expecting rates to be up at over 3.5% by that stage, and seeing a sort of stronger rise in rates far sooner. So there's a disconnect here, and at the moment this week we saw more evidence of the politicians trying to accelerate that sort of move to a more normal economic environment in the US. So the State of the Union address from Barack Obama this week was a very bullish speech about how the US economy is back to a normal footing. So that would call for rates going up a bit earlier than the market expects. And for us, that's quite a big issue in the first 6 months of this year. Would be very positive for things like US banks who benefit from short rates going up if it was to go up sooner than the market expected. So the week ahead, it's a very busy week in the corporate diary. We've got Microsoft on Monday, we've got Apple on Tuesday, we've got Boeing on Wednesday. Thursday we've got Shell, would be very interesting, Google, Amazon, Visa, which we'll talk about. And then Friday we've got BT Group, which is a new buy recommendation for us, and Whirlpool. Just talking about Visa, we continue to buy Visa for the stronger US consumer story. As you can see, it's been a strong share over the last 6 to 12 months. But it's not just a consumer story, it's a structural shift story. So here we've got trends in payments within the US. And as you can see here, the amount of usage of debit cards, we're all sort of probably seeing this in our own lives, is going up, and also credit cards, and the amount of payment on check and cash is starting to go down. We feel that this transition will accelerate this year because of legislation. We've talked about this already in the US on pushing people into chip and PIN, which is far more convenient. But probably more important is the introduction of Apple Pay and the ability for people to pay over their mobiles. Now, prior to September this year, the market was concerned about that being a process that would disintermediate the credit card companies. But Apple Pay has chosen to use the credit card rails and infrastructure that they already have in place because of security issues, and the Apple technology sits on top. So actually it's complementary to these card companies' revenues. So this is a very fast area of growth. We're predicting that the compound annual growth rate in US mobile in-store payments is around 154%, we can see from this chart. And that will be a very strong tailwind to the earnings of American Express and Visa. And we'll see, hopefully, Visa talking about that next week. So thanks very much. Have a good weekend.